I track this stuff closely. Am I the only geek in America that is refreshing my phone at 8:30 a.m. Eastern each month on the release day for the CPI? Actually, I'm probably not the only geek that's doing that, but I bet I'm the only one that you know. Inflation hits more new highs. It just hit its highest level in 13 years. Yes, your dollar is shrinking just like an ice cube melting in your hand. Hi, I'm Keith Weinhold. This is Get Rich Education. We're going to talk about why this matters to you really soon, but in this past week, let's look at these numbers first that were just released, both the CPI and the PPI. Inflation indeed here per CNBC climbs higher than expected June over June as it hits 5.4% consumer price inflation year over year. And inflationary pressures are higher than a lot of people realized, including people in power at the Federal Reserve, including the chairman, Jerome Powell himself. These acute pressures are substantial, unexpected, and maybe more persistent than a lot of people thought now. Now, the prices for some things have actually cooled off, like lumber, an important component in real estate and construction, but we have prices up that are really contributing to this in food staples and car gasoline and used cars. And what's the reason for this really? There are a bunch of them, but it's really continued supply chain bottlenecks and also continued dollar printing. When you've got more dollars and fewer supplies, it takes more of those dollars to chase and buy and purchase those supplies. That's inflationary. Interestingly, this CNBC article does go on to remind us that real wages for workers are not keeping up with inflation here in recent months. This is substantial when wages don't keep up commensurately with higher price inflation. And why might that matter to you? Even if you're a professional, even if you're an investor, even if you can kind of control your income stream, what if your wages are keeping up? Why does it matter to you? You got to think about what this means to your tenant. It can make it less likely that you're able to get rent raises on your tenant, even in an inflationary period, if their wages aren't keeping up with inflation. Now, of course, that's parsed by asset type and geography and a lot of other things within real estate. But what about your tenant having to pay higher prices for car gasoline and food and transportation of all types? That's something that you've got to be attentive to. Now, how do you predict inflation? There is a way to do it, and it is somewhat more nuanced than this, but the PPI can help us predict the CPI. So the PPI is the producer price index. That's how much it costs producers to make stuff. The CPI, as I've been discussing, the consumer price index, is how much it costs you, the consumer, to buy stuff at the cash register. There's actually even service inflation at the cash register. Now that you've got to do some more self-checkout, that's another story. But the PPI recently came in at 7.3%, so torridly hot that it is an all-time record in the history of the PPI being tracked. And you can understand why the PPI, which again came in at 7.3%, we currently have the CPI at 5.4%. Both of these figures were just reported by the Government Bureau of Labor Statistics last week. You can understand that when producer prices are higher, that's going to flow to the consumer, say, a few months later when those products get onto shelves. That's how you can predict inflation. Look at the PPI of 7.3%. That could be indicative of more consumer price inflation that you and your tenants feel in your pocket monthly. Predicting inflation by looking at the PPI. Hey, go ahead and put a YouTube like on this video, whether you like inflation or you don't. I'd really appreciate it. That tells YouTube that it's a good video. It'll also help ensure that more material like this appears in your feed. I'd really appreciate the like. I am like an inflation cheerleader and inflationista overall, if you will, because as a real estate investor with a lot of property that cash flows tied up to long-term fixed interest rate debt, I know it benefits me with that aforementioned inflation triple crown I'm benefiting three ways at the same time, but I don't benefit in every way. Like I talked about, those wage suppression problems can affect my tenant and make it harder to get rent increases. But overall, inflation is generally a good thing in my life. And I think about how it's a good thing in my life overall when I travel. Now, that's easy to forget in the short term. For example, this past week, I've done quite a bit of traveling. I was in Pennsylvania and New York and Illinois and Washington State and Alaska all within the past week, and I ate at restaurants in each one of those states. One thing I experienced, and it's a way that you experience inflation as well, it's not the price of the food even, although that is a factor. It's not that, as I've talked about in previous videos, now more restaurants like even Subway that don't have waiter service are asking for tips. It's none of those things either. You know where you're experiencing service inflation in a restaurant and why it's more expensive than ever for you to go to a restaurant? And I'm experiencing it nationwide, really, just anecdotally, at least in these 5 states, is that there's so little help there. You might have to wait longer to get a table, then the service is slower. Then you have to maybe wait 20 minutes for your check to even come in some instances when you're ready to get up and leave. Well, that's service inflation because you're getting a lower service level for the same price. It takes more of your time. Service inflation. So yeah, then effectively that makes it more expensive to go to a restaurant. And then with classic consumer price inflation, I'll tell you, I don't think I'm a cheap guy. I actually like to spend. There's one product I bought here, just an everyday consumer item. It's my favorite dressing for salad, this Bragg with this great apple cider vinegar in it, $7.75. I don't overpay, I'm just a healthy spender. That gave me some pause when I saw the price on that. Of course, it didn't prevent me from buying it. Anecdotally, I see evidence of inflation and supply chain bottlenecks all over the place. Like my friend that wanted to buy a Specialized, it's a brand of bicycle. It's gonna take him 6 months to get the bicycle. So there are examples of this all over the place, both in the media, both with what the government is reporting and tracking, with what I'm seeing anecdotally, and probably with what you're seeing anecdotally too. And the big word floating around the finance world is this transitory? Meaning, is this a temporary period where we have, say, 5 or 6% inflation, and then soon it's going to level out and go back to close to 2%, or close to the 1.5% to 2% that really is what we've been experiencing in recent years leading up to this run-up? Is that going to happen? Well, no one really knows the answer if those effects are transitory, meaning ephemeral or temporary or short-term. No one really knows. Some think so, including an economist that's appeared on the Get Rich Education podcast with me a lot of times, Richard Duncan, and some other economists. They do think that these effects are transitory and that supply chains are going to come back into balance. But you know the thing that you've got to keep in mind, we do have 5.4% inflation now. Even if it levels off to, say, 2 or 3%, well, the prices are still up at that elevated level. If it slows from 5.4% down to, say, 2%, inflation is still occurring. It's only occurring at a slower rate. We're not talking about deflation here. We're talking about a potential slowing rate of inflation, but they still elevated. That 5.4% is not coming back. That's a permanent elevation in the level of consumer prices. And yes, I track this stuff closely. Am I the only geek in America that is refreshing my phone at 8:30 a.m. Eastern each month on the release day for the CPI? Actually, I'm probably not the only geek that's doing that, but I bet I'm the only one that you know. Now, another way that inflation can hurt investors is what this actually does to you and your investor life is it can make the capital gains tax more punitive. It can punish you more. For example, if you have $500K in whether it's stock or whether it's property, and the value of that, say, goes from $500 up to $550K, just say over a year and a half, 2 years, that 10%, that is merely inflation. That's merely the diminished purchasing power of the dollar. That doesn't represent any more prosperity in your life, that $500 to $550. But yet if you sell the asset, that $50,000 capital gain, you get taxed on that. Taxation is not adjusted for inflation. You didn't have any real gain with that $50K. If inflation is running rampant, this really affects you more because you're getting taxed on something that's not a real gain at all. So higher inflation can make capital gains tax feel more punitive to you. Now, of course, in real estate, there are ways for getting out of that. There's a primary residence capital gains tax exemption of up to $250K being exempt from taxes if you're single, $500K if you're married, or then over here with real estate on the income property side, you can do a 1031 tax deferred exchange and pay zero capital gains tax. There's still no ceiling on that, but that is something important to keep in mind. These phantom gains that aren't even real get taxed because taxation is not adjusted for inflation. So getting more actionable. On Monday, the very next video after this, I'm going to have Tom Wheelwright, CPA and Rich Dad Tax Advisor. He's going to come onto the show with me here and tell us about how capital gains tax rates, which are currently between 15 and 20%, could very well double. So this is really important in an inflationary environment. If you want to be sure to see that video, be sure to subscribe and hit the notification bell here, and then you're going to get that video Monday with Tom Wheelwright and I. It's going to be an awesome conversation. Some popular inflation hedges are, of course, the classic timeless one is gold. Well, from the beginning of this year to now, look at the gold price. It hasn't gone anywhere. That's not really helping you hedge against inflation all that well. Bitcoin's the same. With the recent drop in its prices, it's now priced in dollars at about the same that it was earlier this year. None of those are working as well for you as a piece of real estate that's income property, which cash flows, that's tied to long-term fixed interest rate debt. That's how you're winning three ways at the same time with inflation in that inflation triple crown. The other actionable thing that you can do is if you don't understand this inflation triple crown through real estate investing that I'm talking about, it's a series of masterclass level videos that I published recently. You can watch those right up here and learn how you can actionably profit from inflation. It's completely free to watch those videos. They're open and accessible to you so that you can make this actionable. My name's Keith Weinhold. Thanks for being here. But as always, you weren't here for me. You were here for you. We'll see you in the next video.